crisis. Does anybody here, have they heard of long-term capital management? Okay, this was a hedge fund that blew up back in the late 90s, and it just about caused the entire world financial to melt down. We came within hours of everything freezing up and no credit cards working, not being able to get anything out of your bank account, everything being shut down. What happened was Alan Greenspan got a bunch of very smart people and the world's big banks all together to bail out this hedge fund, and everybody found out about it after the deal was put together. When Lehman Brothers melted down, did you find out about it before it happened, or did you find out about it after the Federal Reserve and the Secretary of the Treasury and everybody got together and came up with a solution, and it was already dissolved and other banks had Bear Stearns and Lehman Brothers? I mean, what happens is there's an emergency and a very few people keep it secret and they try and solve the problem, and then you wake up in the morning, problem solved. Well, what happens in a currency revaluation is there's an emergency going on behind the scenes, the public doesn't know about it, a few people get together in a room and they decide that the solution of the problem is to make gold, for instance, in this thing, the coming currency crisis. You might see gold go from where it is to, say, $8,000 an ounce, or $7,000, as Jim Rickards believes, or maybe $15,000 an ounce, like I think might happen. That's what it requires for that base money to cover the currency supply again, is about 15 grand an ounce or higher. And so the revaluations can be blindingly quick, and they can add up to some mind-boggling figures. This is the Russian revaluations. If you went back to Peter the Great, when he established the gold Russian ruble, and then the revaluations that happened during the Russian Revolution, 10,000 to 1, 100 to 1. In other words, your old currency is no longer useful. You have to bring it into the government and exchange 100 Canadian dollars or American dollars or whatever for one of the new currency that the government is coming out with. And then 50,000 to 1. That's 3 revaluations in this short period during the Russian Revolution. Then 10 to 1, then 10 to 1, and then 1,000 to 1. And when you add all of these together, 1922, 23, 24, 47, 61, and 1998, this went along with the long-term capital management problem. This happened 1 year after the long-term capital management problem, and long-term capital management contributed to the Russian default that caused this currency crisis, where the Russians, they ended up with 0.1% of their purchasing power after this currency conversion. 1,000, you bring in 1,000 of your current Russian rubles that you thought were worth something when you went to bed that night. You get up the next morning, you got to bring them into the bank, and you get to trade those 1,000 for one of the new ones. And what that adds up to is the Russian ruble was devalued 5 quadrillion times over that time frame. This is the amount of theft that governments can perpetrate on their populations. So the opportunity sometimes comes in a bull market that progresses and then peaks, and then you go into a bear market. That's in a Kondratiev summer. In a Kondratiev winter, many times it's a currency crisis that requires an overnight, lightning-fast revaluation, and the opportunity does not exist after that. I believe, though, that what will happen is you're going to see people, if gold did get revalued suddenly to $15,000 an ounce, the opportunity is gone there, but where is silver? So I think right after a revaluation, you would see people flooding into silver. This is the Dow-gold ratio inverted. So it's upside down. This is the Dow Jones Industrial Average, or the US stock market basically, priced in gold instead of dollars. So each day, 3 minutes. Okay, I got to hurry up. I'm almost at the end anyway. So every day you take the points on the Dow, divide it by the price of gold, and you've got how many ounces of gold one share of the Dow would cost. And right now we're in this big pullback. And it's very similar to this pullback that we went through in the 70s, although not as big yet. It might get quite a bit deeper here, so it might sort of mirror that. But, and if it does, the revaluation will just be more intense, I believe. Fair value, I'm going to go back on this. Fair value is in this range of 3 to 5 here, where it spent a lot of time back in the late 1800s, early 1900s, throughout the 30s and 50s. It spent time in this range, and in the 80s. And then overvalued is this range of 2 to 3 ounces of gold. When it gets above 2, it's in bubble territory, gold compared to stocks. But we're coming off of the most out of whack in history. So if you draw some trend lines here, I really believe that the further down this goes, the more it's going to explode to the upside. And I think you're going to see a day where the price of gold is double whatever the points on the Dow are. And this is the gold-silver ratio. So I've inverted this also. So silver's value right now is 1/67th the value of gold. Historically, though, it was 1/12th, and then it was 1/15th when governments started manipulating it, the Bank of England and so on. But it's been out of whack for more than a century. Now, if we have this deflationary thing and you see gold pull back to 1,000 or even 900, I think that this could actually hit 100 again. So silver wouldn't keep up with gold, but I won't be buying gold. Right now I buy about 80% silver and take my currency, split it 80-20. I buy 80% silver, 20% gold. If it gets over 80, I'll be buying 100% silver, not gold, and it'll be going against all of the emotions. Your inclination is going to be to buy gold. I will be buying silver. I'll be going against the grain. And if it does go down to 100, I think the revaluation will be even higher. So it'll magnify your gains. If it went down to 100 and we went back to a valuation of 10, it means that you, by investing in silver, you got the gains of gold magnified by a factor of 10, so times 10. Right now, if we go to 10 to 1, that means it could be 6. And so here's the S&P from 1871 until today. The S&P only goes back to 1950. However, Robert Shiller just took the largest 500 companies in America. This is with dividend yields reinvested annually and then divided by gold. And if you take that and you invert it, you have the Dow gold ratio and then the gold Dow ratio. So instead of, go back again. So instead of the red line, instead of the Dow priced in gold, you have gold priced in shares of stock, the Dow or the S&P. And if you were to put $1 in here, this is my final frame, so I'll be out of here right away, and then shifted in 1929 from stocks to gold, and then from gold to stocks, and so on and so forth, your $1 invested there would be just under $11 million today. Now I know none of you were alive in 1871, but still, this is a way of developing generational wealth. It's very powerful, and it's powerful within your lifetime. Thank you very much. I'll see you next time.